You've probably heard that Roth conversions are one of the smartest tax moves you can make in retirement. Financial advisors everywhere are recommending them, and for good reason. But what if I told you that in certain situations, doing a Roth conversion could actually cost you thousands of dollars? My name is Patrick Shope, founder of Shope Financial, and today I'm going to show you four specific reasons why a Roth conversion might not be right for your situation. Now, Roth conversions can be incredibly powerful tools, but like any financial strategy, they're not universally beneficial. In case you weren't aware, a Roth conversion is when you move money from a traditional IRA or 401k to a Roth IRA. You pay taxes now, but then it grows tax free forever, and your heirs inherit it tax free in the future. Today, I'm going to walk you through four situations where you might want to pump the brakes in this strategy. By the end of this video, you'll know exactly when a Roth conversion could backfire and what to consider before making this decision. And if you like this content, please make sure to like and subscribe to the channel. It helps us to reach other people who could benefit from this type of content. The first reason you might want to avoid a Roth conversion is what I call the behavioral hurdle. This might sound simple, but it's actually one of the most overlooked factors in retirement planning. Let's just say that you're considering converting $200,000 from your traditional IRA to a Roth. If you're in the 24% tax bracket, that conversion is going to create a tax bill of about $48,000. That's a big check to write to the IRS, even if it makes mathematical sense for the long term plan. Here's the thing about personal finance that a lot of people forget: it's personal. The stress and anxiety of writing that $48,000 check might outweigh any potential future benefit. I've seen people lose sleep over large tax payments, even when they know it's the right move on paper. Think about it this way: would you rather pay $48,000 all at once, or would you prefer to pay smaller amounts over time as you withdraw from your traditional IRA in retirement? You see, for some people, the peace of mind that comes with predictable, smaller tax payments is worth more than the theoretical tax savings of a conversion. This isn't being financially irrational. It's about understanding your own comfort level with large, immediate expenses. If the thought of that one big tax bill keeps you up at night, that's a perfectly valid reason to consider alternative strategies. But let's move on to reason number two, which is more mathematical. You should avoid a Roth conversion if you don't have money outside of your retirement accounts to pay the tax. Here's why this matters so much. Let's say you want to convert $100,000 from your traditional IRA to a Roth, and that creates a $22,000 tax bill. If you have $22,000 in a savings account to pay that tax, great. You convert the full $100,000, pay the tax from your savings, and now you have $100,000 growing tax free in your Roth. But what happens if you don't have that $22,000 in outside money? Well, you'd have to use some of the IRA money itself to pay the tax. So instead of converting $100,000, you're really only converting $78,000 to the Roth, and $22,000 goes to pay the taxes. Now you might think, well, at least I still have $78,000 in the Roth. But here's the problem: that $22,000 you used to pay the taxes, it's gone forever. It can't grow tax free for the next 20 or 30 years like it would if you paid the taxes from outside funds. Let me show you the math. If that $22,000 had stayed invested and grown 6% per year for 20 years, it would have become $70,000. So by not having the outside funds to pay the taxes, you've essentially given up $70,000 of future tax-free wealth. This is why financial planners often say you should only do Roth conversions if you have non-retirement money to pay the taxes. Without that outside money, you might be significantly reducing the benefit of the conversion. Now, here's something that might surprise you. Reason number three for avoiding a Roth conversion is if your heirs are going to be in a much lower tax bracket than you are. One of the biggest selling points of Roth conversions is that your children, maybe even your grandchildren, will inherit the money tax free. But let's think about this logically. If you're in the 32% tax bracket and your kids are just starting their careers in the 12% tax bracket, are you really doing them a favor by prepaying their taxes at your higher rate? Let's use a real example. Imagine you're 65 years old, earning good money, and you're in the 32% tax bracket. You're thinking about converting $150,000 to a Roth. This would cost you about $48,000 in taxes. Your daughter is 28, just starting her career as a teacher, and she's in the 12% tax bracket. If you don't do the conversion and she inherits that traditional IRA, she'll eventually pay taxes on it at her 12% rate. That same $150,000 would only cost her $18,000 in taxes instead of the $48,000 you would pay. I know what you're thinking. Won't she eventually be in a higher tax bracket as her career progresses? Maybe, but maybe not. And even if she does move up, there's a good chance she'll still be in a lower tax bracket than you are now. Think about who's inheriting your money. Are they young adults just starting their careers? Are they teachers, social workers, or in other professions that typically don't lead to high tax brackets? If so, you might be solving a problem that doesn't exist by prepaying taxes at your higher rate. This is why it's crucial to consider not just your current tax situation, but the likely tax situation of the people who will inherit your money. The fourth and final reason to reconsider a Roth conversion is one that catches a lot of people off guard. Large conversions can trigger what I call shadow taxes on your other income, particularly your Social Security benefits. Here's how this works. When you do a Roth conversion, that income gets added to what we call your provisional income. Provisional income is used to determine how much of your Social Security benefits become taxable. The thresholds are $32,000 for married couples and $25,000 for singles. Let me walk you through a real example. Let's say you're married. You normally have $40,000 in other income and you receive $30,000 per year in Social Security benefits. Your provisional income would be $50,000. At that level, about 85% of your Social Security benefits are taxable. Now, if you do a $100,000 Roth conversion in that same year, your provisional income jumps to $155,000. You're still at the 85% level for Social Security taxation, so that doesn't change. But here's the key point. You need to factor in not just the direct tax on the conversion, but also any additional taxes on your Social Security benefits. In some cases, especially if you're right at the threshold where more of your Social Security becomes taxable, a large conversion can push you into what's effectively a much higher tax bracket than you realize. You might think you're paying 24% on the conversion, but when you factor in the additional Social Security taxes, your effective rate could be much higher. You see, this is why timing and amount matter so much with Roth conversions. Sometimes it's better to do smaller conversions over several years to avoid these shadow tax effects. So, where does this leave you? Roth conversions are powerful tools, but they're not right for everyone in every situation. If you're emotionally uncomfortable with large tax payments, if you don't have outside funds to pay the tax, if your heirs will be in a much lower tax bracket, or if the conversion will trigger significant shadow taxes, you might want to think twice. The key is to run the numbers for your specific situation. Look at your current tax bracket, your expected retirement tax bracket, and the likely tax situation of your heirs. Consider whether you have funds outside your retirement accounts to pay the conversion taxes. And then don't forget to factor in the impact on other income like Social Security. Remember, the goal isn't to minimize taxes this year or next year. is to minimize your lifetime tax burden while also considering the tax burden of your heirs. Sometimes that means doing conversions, and sometimes it means leaving your traditional accounts alone. If you want to understand the other side of this equation, make sure to like and subscribe to the channel. We publish content weekly to provide insights into retirement planning you or your loved ones may need. And we'll be posting a video on the reasons you might want to consider a Roth in the near future. As always, this is Patrick Show, wishing you a stress-free and prosperous retirement. I'll see you in the next video.